Hey, what's up everyone? Welcome back to the channel and I hope you're all doing well. In this video, I'm going to talk about RESPs. What is an RESP and how does it work? How much does the government contribute to an RESP? How much can you make through an RESP? And can you lose money through an RESP? Answers to this and more. Let's jump right in. An RESP stands for Registered Education Savings Plan. It's a tax-sheltered plan offered by the government that helps you save for your child's post-secondary education faster. The main advantage of an RESP is its tax-advantaged nature. The account can be opened by the child's parent, grandparent, or a family friend, or almost anyone as long as they have access to the kid's social insurance number. And both the person opening the account and the beneficiary need to be Canadian residents. In other words, it's an investment account designed to help you save for your child's education. And it's the best way to save because the government contributes up to $7,200 through an CESG, which stands for Canada Education Savings Grant. And your RESP grows tax-free as long as the funds stay within the account. And in most cases, students benefit from this free money without having to pay any tax whatsoever. Let's talk about three different types of RESPs. The first one is an individual RESP, and it's the most straightforward in a sense that anyone can open up the RESP and contribute to it. This can be a parent, a grandparent, or even a generous stranger who has money to burn, or even you watching this video. And individual RESPs are non-transferable except to a sibling. The next type is a family RESP, which is a lot more flexible than compared to the individual RESP. You, the plan holder, can name one or more children as the beneficiaries. The beneficiaries being the children or people who you're saving the money for. But they must be related to you. And the beneficiaries must be siblings related to one another in order to receive the Canada Education Savings Grant or CESG. And I will talk in more detail about the CESG a little bit later in this video. Children, grandchildren, adopted children, or even stepchildren are fully eligible. And if the eldest child decides not to go to post-secondary school for whatever reason, under certain circumstances, the grant money can be transferred to other beneficiaries. And you don't have to split the payments evenly among the children. However, the beneficiaries must be under the age of 21 in order to be added to this plan. The third type is a group RESP. In a group plan, one single child is a beneficiary, and that child does not have to be related to you. However, since many different people are contributing to this plan, the beneficiaries share the pooled earnings from various investors and with the children of the same age. And these group plans tend to have more restrictions and rules surrounding them compared to the other plans I just listed. And by the way, if you're new to the channel or you've seen my content before, please do me a huge favor. Hit that like and subscribe button. It does two main things. One, it lets me know to produce more content like this. And two, you don't miss out on future tax-related videos. So in a nutshell, an RESP lets you get free money from the government, and you can grow this free money along with your own contributions tax-free as long as those pooled earnings stay within the plan. This is one of the main benefits, but there are other benefits, and let's take a look at them. One of the other major advantages of an RESP is that you can save on taxes, and who doesn't like to save on taxes? You can save thousands or even tens of thousands of dollars when investing for your child's education through an RESP, because an RESP is a tax-advantaged account, and as long as you follow the steps and concepts outlined in this video, you can maximize that nature. And when your child ultimately uses RESP for their school, they may have to pay no or very little tax. This is an important note. When you contribute money to an RESP, you do not get an upfront tax break. However, any gains or any income earned through an RESP does not have to pay any income tax or any capital gains tax as long as the funds stay within the account. When funds are withdrawn and used for an approved education expense like going to university or college, think of things like paying for tuition, housing, books, etc. This income, which is the money withdrawn from an RESP, will be reported by the beneficiary, aka the student, on their personal tax return. And since student income is generally either non-existent or very low, the students in this case, when withdrawing money from an RESP, end up paying very little tax or no tax at all. So in summary, you invest the money, the government gives you free money, you grow that money tax-free, the student withdraws the money, and the income is taxed on their return. But if their income is very low, they end up paying zero or very little tax. And throughout this video, I've mentioned this free government money and these government grants a few times over. So what does that actually mean? Well, that's our second main benefit, the Canada Education Savings Grant or the CESG. And since 1998, the government launched this program to match 20% of an RESP's contribution up to $2,500 per child per year. So that means if you do the math, the government will give you $500 at max per year per child. That's assuming you're contributing $2,500 a year in the the first place. And lower income families can get even more money from the government for the CESG. Children coming from low income families are also eligible for the CLB, which is known as the Canada Learnings Bond, which is basically an additional $2,000 free from the government to help contribute to an RESP, which breaks down into $500 for the first year of eligibility and $100 per year as long as a child remains eligible for the CLB up to and including the year they turn 15. What does your family income look like to be eligible for this program? Well, check out this chart. It shows you the qualified income levels based on the number of children you may have. The next main benefit of an RESP is to be able to grow your money and invest it tax-free. And I've talked about this a little bit throughout the video. So let's talk about what it actually means to grow your money tax-free. Just like how you can with a TFSA and RRSP, you can invest in things like stocks, bonds, ETFs, mutual funds, GICs, pretty much any kind of investment type. You can do the exact same thing with an RESP. And whatever income or capital gains you earn within this account, you don't pay any tax on it as long as that money stays within the account. That's pretty cool if you ask me. So those are the main benefits of an RESP. And when things have certain benefits like that, there are also certain limitations. So let's talk about the limitations of an RESP. And one of the major limitations surrounding an RESP have to do with the CESG. Regardless of family income, no child can collect more than $7,200 from the CESG throughout its lifetime. The other major risk with an RESP is that the money has to be used for educational expenses after your child graduates from high school. They may not want to go to university or college, so then you can look into a vast array of other education and on-the-job training programs that qualify for the use of RESP funds. Now, for example, what if the beneficiary has no intention of going to university or college or pursuing any other education programs or on-the-job programs after high school? Then the RESP can be transferred. Now, what happens if there is no one to transfer the RESP to? In that situation, you must then close the RESP. And when an RESP is closed, all those government grants that you've been collecting have to be repaid back to the government. And all the gains and income you've been earning inside this registered account will be subject to tax. Thankfully, however, you can keep an RESP open for as long as 36 years. That gives you plenty of time to figure out your options. Under current law, you can contribute a lifetime maximum of $50,000 per beneficiary to an RESP. The contribution room keeps accruing up to and including the year the child turns 17. So it's possible to catch up to that free CSG money even if you missed out on a year or two of contributions. Now, if you want to maximize the CESG, you want to follow and consider the following steps. You'll want to contribute $2,500 per year per beneficiary for 14 years, and then top it off with an extra $1,000 in the 15th year. And this is because the total CSG a child can receive is $7,200. And if you miss a year or started late, you can contribute more than $2,500 to retroactively claim those grants. You're eligible to receive an additional $500 in CSG if you missed previous year's set of grants. In short, you can catch up for one previous year at a time by contributing more than $2,500 per year. The ultimate goal of an RESP is to fund your child's future education expenses, and ultimately, your child will need to withdraw this money. Let's talk about how you can actually access this money when the time comes. Only the person who set up the account and made the contributions can actually make those withdrawals. They're known as a subscriber. And there are three main components of an RESP. One are the funds you've been contributing. Two, it's the free government money you've been collecting. And three, it's the gains of the investments you've made. And withdrawals of the contributions made by the subscriber are called post-secondary education payments, or PSE, and they may be sent to either the subscriber or the beneficiary. Withdrawals of the government grants or bonds are known as the education assistant payments, or EAP, and they can only be sent to the beneficiary. The subscriber has to provide proof to the financial institution holding the RSP, proof of enrollment, before being able to allow access to the funds. The PSE payments that I just talked about are not taxable. The student, however, will be taxed on the EAP payments, however, and those EAP withdrawals consist of two portions, the government grants and the investment gains. The financial company who holds the RESP will issue a T4A form in the student's name for the EAP payments only. Why? Because only the EAP is taxable, while the PSE is not taxable. There's also a $5,000 limit or a $2,500 limit if the student is enrolled part-time on EAP contributions during the first 13 weeks of studies. However, there is no limit on the amount of PSE that can be withdrawn, and once those 13 weeks have passed, any amount of EAP contributions can be withdrawn. Now, the other question you may have is, how does an RESP compare to the TFSA or an RRSP? While the TFSA and RRSP are also tax advantage accounts, each comes with their own unique benefits and drawbacks, and it all really depends on your personal situation. I have separate videos on how TFSAs and RRSPs work, so I highly recommend checking out those videos so you can learn how to maximize both the TFSA and RRSP and avoid those costly mistakes. RRSPs are great for retirement when you know you'll be in a lower tax bracket, and TFSAs are great for savings goal because the money you withdraw will not be subject to any tax. While RESPs, on the other hand, are great for young people starting off their education and financial journey. And personally speaking, I used an RESP that my parents had set up. So when I was going through university and paying for tuition, books, etc., I fully understand how crucial and important that financial support was to be able to pay for those costs without worrying about studying and where that money is coming from. So I highly recommend you start an RESP for your child, even if you can only contribute $50 a month, but maybe have a goal to grow what you can contribute as the years go by. Because when you leave that money to grow tax-free, the power of compound and time works wonders because it does all the heavy lifting for you. So far we've talked about what an RESP is, how it works, the different types of an RESP, the benefits, the limitations. Now let's talk about how you can actually open an RESP and what you need to know before you open one. And you will have countless choices of financial institutions where you can open an RESP from. But consider trying to find the ones that have no minimum investment required, very low cost, and one that provides support from knowledgeable individuals. And more specifically, you'll want to pay attention to the following items before you decide to choose the institution you want to open an RESP with. You'll need a social insurance number in order to open an RESP. Your child or other beneficiaries will also need to have their own social insurance numbers, and you both need to be Canadian residents. Number 2, different type of RESP providers offer different types of plans, which come with their own set of rules and restrictions. Decide which plan is the best for your individual needs, whether it's an individual RESP plan, a group RESP, or a family RESP. You want to find out who offers those plans and what your choices are. 3, you need to decide how you're going to invest those savings, and likely your options will depend on the provider you ultimately choose. And as I mentioned earlier in this video, you can invest in almost any type of instrument, whether it's stocks, bonds, ETFs, you name it. The other option you want to consider, maybe you want to open up a self-directed RESP. This often has the lowest cost and gives you full control of exactly how you want to manage the RESP. And if you're looking for ideas on how to get started with those investments, whether it's stocks or ETFs, make sure to check out the following series. Number 4, understand the fees and penalties. You need to understand how much the plan will cost you. Are there sales fees, setup fees, annual fees, ongoing monthly recurring fees? You have to pay any additional fees or penalties for making any changes you may ultimately want later on. Number 5, read all the information very carefully before you sign any sort of paperwork. And most plans will provide written information about how the plan works, all the ins and all the outs. It'll talk about all the rules, the fees and penalties, so make sure you fully understand how all those mechanics work. And lastly, number 6, you are now ready to open the RESP and apply those government grants.